Do you want to invest in stocks but don't know where exactly to start? Then you've come to the right place. Hey everyone, and welcome back to our channel. In this video, we'll be talking about how to start investing in the stock market. But before we start, do consider subscribing to our channel and turn on the notification bell to watch more of our exciting content. Let's get started. It might surprise you to know that a $10,000 investment in the S&P 500 index 50 years ago would be worth around $1.2 million today. Stock investing, when done correctly, is among the most effective ways to earn long-term wealth. But there are a few things that you need to know before you jump into investing, and we're definitely going to tell you what you need to know. The first thing to look at is how to begin investing in stocks. Some investors tend to buy individual stocks, while others opt for a less active approach. There are different ways to invest in the stock market. Let's look first at individual stocks. You can invest in individual stocks if and only if you have the time and wish to research and evaluate stocks on an ongoing basis thoroughly. If this is the case, we 100% motivate you to do so. An innovative and patient investor can beat the market over time. On the other hand, if matters like quarterly earnings reports and average mathematical calculations don't sound appealing, there's absolutely nothing wrong with taking a more passive approach. Secondly, we have index funds. In addition to purchasing individual stocks, you can choose to invest in index funds, which track a stock index. Index funds usually have significantly lower prices and are virtually guaranteed to match the long-term performance of their underlying indexes. Thirdly, we have Robo Advisors. Finally, another option that has come up in popularity in recent years is the Robo Advisor. A Robo Advisor is basically a brokerage that essentially invests your money on your behalf in a portfolio of appropriate index funds for your age, risk tolerance, and investing goals. Not only can it select your investments, but many optimize your tax efficiency and make changes over time automatically. Once you have decided how you wish to invest, choose how much you wish to invest in stocks. First, let's talk about the money you should not invest in stocks. The stock market is not a place for money that you might need within the next 5 years. At a minimum, while the stock market will almost certainly surge over the long run, there's just too much uncertainty in stock prices in the short term. In fact, a fall of 20% in any given year isn't unusual. In 2020, during the COVID-19 pandemic situation, the market plunged by more than 40% and rebounded to an all-time high within a few months. Now let's discuss about what to do with your investable money, that is, the money you won't need within the next 5 years. This is an idea known as asset allocation, and a few factors come into play here. Your age is a significant consideration, and so are your particular risk tolerance and investment objectives. Let's start with your age. The general idea is that stocks gradually become a less desirable place to keep your money as you get older. If you're young, you have years ahead of you to go through many ups and downs in the market. But this isn't the situation if you're retired and reliant on your investment income. There's a quick rule of thumb that can aid you in establishing a ballpark asset allocation. Take your age and reduce it from 110. This is the almost percentage of your investable money that is supposed to be in stocks. The remainder should be in fixed income investments like bonds or even high-yield CDs. You can also change this ratio up or down depending on your particular risk tolerance. For instance, let's say that you're 40 years old. The rule suggests that 70% of your investable money should be in stocks, with the other 30% in fixed income. If you're more of a risk taker or plan to work past the typical retirement age, you may want to shift this ratio in favor of stocks. On the contrary, if you don't like significant fluctuations in your portfolio, you might want to modify it in the other direction. All of the tips about investing in stocks for beginners don't do much good if you don't have any way to buy stocks. To do this, you'll need a specialized type of account called a brokerage account. These accounts are offered by TD Ameritrade, E-Trade, Charles Schwab, and a lot more. And starting a brokerage account is usually a quick and painless process that only takes minutes. You can also easily fund your brokerage account through EFT transfer, mailing a check, or wiring money. Starting a brokerage account is generally easy, but you should look out for a few things before choosing a particular broker. First, choose the type of brokerage account you need. For many people who are just trying to learn stock market investing, this means choosing between a standard brokerage account and an individual retirement account. Both account kinds will allow you to buy stocks, mutual funds, and ETFs. The primary considerations here are why you are investing in stocks and how quickly you want to access your money. If you need quick access to your funds, are just investing for a rainy day, or wish to invest more than the annual IRA contribution limit, you will probably need a standard brokerage account. On the other hand, if your aim is to build up a retirement nest egg, an IRA is an amazing way to go. These accounts come in two main varieties, traditional and Roth IRAs, and some specialized types of IRAs for self-employed individuals and small business owners, including the SEP IRA and the Simple IRA. IRAs are tax-advantaged places to purchase stocks, but the downside is that it can be difficult to withdraw your money until you get older. The majority of online stock brokers have stopped trading commissions, so most are on a level playing field as far as costs are concerned. However, there are several other significant differences. For instance, some brokers offer customers a variety of educational tools, access to investment research, and other features that are especially useful for newer investors. Others provide the ability to trade on foreign stock exchanges, and some have physical branch networks that can be nice if you need face-to-face investment guidance. There is also the user-friendliness and functionality of the broker's trading platform. Many platforms will let you try a demo version before committing any money, and if that's the case, it would be helpful to understand the platform and try it without actually investing any money in it. Now that we've looked into the question of how you buy a stock if you're looking for some fabulous beginner-friendly investment ideas, here are 5 great stock tips to help get you started. Of course, we cannot go over everything you should consider when selecting and analyzing stocks in just a few minutes, but here are the essential concepts to master before you get started. Firstly, diversify your investment portfolio. Invest only in businesses you can understand. Try to avoid high volatility stocks until you get the hang of investing. Always avoid penny stocks. And lastly, and the most important thing, learn the basic metrics and concepts for evaluating stocks. It's a good idea to understand the concept of diversification, which means that you should have a number of different types of companies in your portfolio. Yet we caution against too much of diversification. Stick with the businesses you understand, and if it turns out that you're good at evaluating a specific type of stock, then there's nothing wrong with one particular industry making up a relatively large chunk of your portfolio. Buying flashy high-growth stocks can seem like a great way to build wealth, and it indeed can be, but we caution you to hold off on these until you're a little more experienced. It's better to create a base for your portfolio with rock-solid established businesses. If you wish to invest in individual stocks, you should first familiarize yourself with some basic ways to evaluate them. Lastly, one of the greatest secrets of investing, courtesy of the Oracle of Omaha himself, Warren Buffett. You do not have to have extraordinary things to get great results. Note that Warren Buffett is not just the most successful long-term investor of all time, but also one of the best sources of wisdom for your investment plans. The most surefire path to making money in the stock market is to purchase shares of great businesses at reasonable prices and hold on to the shares for as long as the enterprises remain great or until you need the money. If you do this, you'll see some volatility along the way, but over time you'll produce excellent investment results. With that, we are at the end of the video. If you found it interesting, make sure to hit the like button and subscribe to stay tuned for more exciting videos. Let us know your thoughts in the comment section below. See you again with another exciting video. Until then, bye!